Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. So today we are going to discuss two very important notifications of the Reserve Bank of India that is released in the April month. Okay, so these both notifications, they are important from the phase 1 as well as from the phase 2 perspective, specifically for the objective part. Okay. So let's get started. First of all, we are going to discuss the limits for the investment in the debt and the sale of credit default swaps by the foreign portfolio investors. So there are different limits that have been determined for the foreign portfolio investors. So that we will discuss. Next, we will discuss the master action where two schemes have been discussed. Okay. So one is the scheme for the incentives and the other one is the scheme for the penalties. So we will discuss that what are the incentives, what is the data for the incentives, and then we will also talk about the penalties, but that is for the next session. Okay, so today we will discuss the master action on the incentives for the currency distribution and exchange. Okay, so this is the idea for today. Good morning everyone. Good morning Ronak. Good morning everyone. And these are the two notifications that we are going to discuss in today's session. Okay, and I hope you know that the Utkarsh has also been released, so that also we will discuss that when we are going to cover the Utkarsh 2029. Okay, so let's get started without any delay. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, and do join our Telegram channel where you will get the PDF of the session. And the link for the Telegram channel is provided in the description box below. So you will get the PDF of the session within 24 hours. Okay, or tomorrow is Sunday, so maybe the team will provide it by Monday. Okay, so tomorrow is Sunday, so team may be provided the PDF by Monday. Okay, so now let's get started. Am I clearly audible and the screen is visible? Give me a thumbs up if everything is fine. Okay, so it seems that everything is fine. Let's get started. Okay, chalo. So now we are going to start with the first topic, that is the limit for investment in debt and sale of credit default swaps by foreign portfolio investors for the 2026-27, that is for the new financial year. Okay, so the limits for FPI investment in government securities. See, the limits have been determined for the government securities, state government securities, and the corporate bonds. So it is said that the FPIs, the foreign portfolio investors, they have the limit of 6% in the government securities. So out of the total outstanding stock of securities. Outstanding stock of securities means total value of securities that are that have not matured in the market. Okay, so the total value of the securities that are still present in the market. So from the total value of the government securities that are present in the market, 6% is the limit for the FPIs. So if the total value of the securities or the outstanding stock of securities, the government securities that are present in the market is 100 crores, so 6 crore is the limit for the FPIs. Okay, now the state government securities, out of the total value of securities in the market, the state government securities, now the investment that can be done by the FPIs is 2% of the total value of the securities. Okay, for the corporate bonds, the limit is 15% for the FPI. So these are the limits first of all, and they have not been changed. And as you might remember that in the previous years there was a question from the limits directly. Okay, so this is important that the limit for the foreign portfolio investment has been notified for the government securities, for the state government securities, and the corporate bonds. So out of the outstanding stock of securities, out of the outstanding stock of government securities, the limit for FPIs is 6%. Out of the outstanding total value of securities that have not matured, that are present in the market, for the state government securities, the limit is 2% for the FPIs, and for the corporate bonds, the limit is 15% for the FPIs. This is very important. Okay, next, now coming to the next point, that is the allocation of incremental changes. Think about it, that the union budget has been released. Now the union budget that was presented by the finance minister in front of the parliament, in front of the Lok Sabha. So in the union budget, what is notified? What is notified, or what is this union budget talking about? It is talking about the expected expenditure of the government and the expected revenue or the receipts of the government. Can we say that the expected expenditure of the government, if we exclude the borrowings, so expected expenditure of the government expenditure is going to be higher than the receipts of the government? if we exclude the borrowings of the government, then can we say that the expenditure, the government is going to spend more than the receipts of the government? Can we say so? Right? This is the idea, that the government is going to spend more than the receipts of the government. So now if the government is going to spend more than the tax receipts, the dividends that it is receiving, the fees, fines, penalties that it is receiving. So if the government is going to spend more than its general receipts, so how the government is going to spend more? From where the money is going to come for its extra expenditure? For its extra expenditure, the borrowings. The government will be borrowing for its extra expenditure, right? So already through the union budget that was released on 1st Feb 2026. So through this union budget, it was informed that for the 2026-27 financial year, what is the expected expenditure, what is the expected receipts of the government, and the government notified that this is going to be the extra expenditure that the government will be doing. This is going to be the expected fiscal deficit. The fiscal deficit shows the extra expenditure of the government in comparison to the receipts. Okay, so already the fiscal deficit percentage has been provided, that this is going to be the extra expenditure of the government in comparison to the receipts of the government, excluding borrowing. So fiscal deficit actually shows us the borrowing requirement of the government. So government has given a estimate that this is the borrowing requirement of the government for the 2026-27 for the extra expenditure that the government wants to do for the welfare activities, for the different schemes that the government is bringing. So the government has to do extra expenditure, and this is the borrowing requirement of the government for 2026-27. According to this borrowing requirement for the financial year, for the new financial year, the RBI notifies that how much the foreign portfolio investors can invest in the government securities. Okay, so according to the borrowing requirement that the government has notified for the coming financial year, the RBI gives limits to the FPIs that how much they can invest in the government securities, because it is already notified that the FPIs have certain limits of investment in the government securities. So if, let's say, the government in 2025-26 had the outstanding like stock of government securities, this is the total value of the government securities, this is the total value of the government securities that is present for the 2026-27, okay, from the previous year. This total value of the government securities that did not mature in the previous year, and this continued for the 2026-27. Okay, so this is the previous government securities that were issued in the previous financial year or before that, and these government securities, they have not matured, they are continuing. Now in the 2026-27, as per the government, as per the expected expenditure, as per the expected borrowing requirement of the government, it is said that the government is going to borrow 100 crores more. Now this is what? This is the incremental borrowing of the government, or the government is going to borrow additionally in 2026-27. So the idea is that the government had borrowed previously in the previous financial years, the government has borrowed that is still not matured. The government securities have still not matured. Okay, so still there is the outstanding stock of securities that has continued from the previous years. So the outstanding stock of securities for 2026-27 from the previous year that has continued is, let's say, 1000 crore. Now the government is saying that in 2026-27 particularly, the government is going to issue new government securities worth 100 crore. So from this outstanding stock of securities, 6% is the foreign portfolio investment limit for the government securities. Now from the incremental government securities, the new government securities that the government is going to release in this financial year, what is the FPI limit for the government securities? Anyone can tell me? So these government securities, they did not mature and they are continuing. That's why this is the outstanding stock of securities. Now this incremental securities, this new government securities that the government is issuing from this particular government securities, what is the limit for the foreign portfolio investors for the government security? The limit is still 6%. The limit is 6% because once they are released in the market, they are also the outstanding stock of securities, they are also the total value of securities for the government securities. Okay, so 6% is the limit. Okay, that is 6 crores. The FPIs can invest. Now it is said that out of this 6 crore, from the incremental government securities, 50% should go for the general investors, that are the flexible investors. They trade very frequently in the market, or they trade frequently, while the other 50% should go for the long-term investors. Okay, so this is the idea, that the allocation of the incremental changes in the government security limit. That means the new government securities will be released in the market soon, and this has been decided that the government is going to borrow from the market, and so new government securities will be released. The new government securities will be released, so the government security total outstanding in the market is going to increase. So from that, 6% is the limit. So out of the 6%, 50% or 50 ratio should go to the general investors, to the general foreign portfolio investors that usually trade more frequently, while the other 50% should go to the long-term investors, such as the sovereign wealth funds that usually invest for the longer period of time, or the insurance funds, the pension funds that usually invest for a longer period of time. Okay, so 50% should go to the long-term FPIs, so that there is stable investors that are also present under the FPIs. Under the FPIs, there is also some part of the government securities that is going to the stable investors. Okay, some part of the government securities, that is 50% of the government securities, should go to the stable investors. So this is the total limit. This is the total limit of the foreign portfolio investors. Out of this, basically 50% should go to the general investors that trade more frequently, and 50% should go to the stable investors that are the long-term investors for the government securities, it has been said. While for the state government securities, the entire increase in limits of state government securities, so whatever new state government securities are going to be issued, from that 2% is the limit for the foreign portfolio investors. Now it has been said that only general subcategory of the state government securities, that means this whole 2% limit should go to the general foreign portfolio investors. Okay, that is the idea. So here you can see that the RBI has also given the absolute value of how much is the limit for the FPI. So in the percentage terms, 6% for the government securities, 2% for the state government securities, 15% for the corporate bonds. But the RBI, in terms of the absolute value, also has given these limits. Okay, that you can see revised limit for the first half of the 2026-27 financial year, and the revised limit for the second half of the 2026-27 financial year. Here you can see that in the government securities, whatever is the limit, 50% is for the general investors, like the increase that is happening in the government securities, that is by 7,257, I guess here, and 7,000, yes, 257 here. So whatever is the increase, that is around 14,500 crores, 14,500 crore rupees. So 14,500 crore is the absolute limit, we can say, for the government securities for the foreign portfolio investors. So 50% of that is going 7,257. This is the incremental limit. Okay, because the previous government securities, previous value of the government securities, that is there, but the increase that is happening in the government securities from the incremental, that is the increase that is going to happen in the government securities in 2026-27, from the incremental changes in the government securities, this new government securities, from this half should go for the general investors, and half, that is 7,257 crores, should go for the long-term investors. Any confusion? No, you don't have to remember the absolute numbers. Percentages are important. 50% for the general, 50% for the long-term investors. For the government securities, this is important. For the state government securities, only general limit. Here you can see whatever increase is happening in the state government securities, it is only for the going for the general investors. There is no increased limit for the long-term investors. Okay, or whatever increment, whatever state government securities are released new, from that only the general investors can invest in, not the long-term investors. This is the idea. This table is just to show you that, okay, for the general investors, long-term investors, there is the equal increase. The incremental changes are equally divided between the general investors and long-term investors. 7,257 crores increase in the for the general investors, 7,257 crores increase for the long-term investors also. For the state government securities, all the increase is going only for the general investors, not for the long-term investors. That is the idea. Okay. Chalo. Yes. So this is important. The points are important. The table is not important. You cannot remember so many of the values. Neither it is required. No need to remember this. Just the idea needed to be clarified. Okay. Now coming to the next point, that is with effect from April 1, 2026, all existing and future investments under the voluntary retention route. Voluntary retention route means that the foreign portfolio investors have promised that they are going to hold their investment for 3 years. For at least 3 years, let's say. So there is a timeline that has been given by the foreign portfolio investors that they are going to voluntarily hold their investment in India for a period of time, for a longer period of time. So under the voluntary retention route, before there were separate limits. Okay, before there were separate limits for the voluntary retention route, but now it has been said that this voluntary retention route, this will also be subjected to the investment limits, that is for the foreign portfolio investors under the general route. That means for the voluntary retention route also, it will come under the limits of the general route. So if the investors have to invest, they have to invest under the voluntary retention route, and it has the same limits as the general route limits. Okay, or it comes under the general route limits. So general route limits for the government securities, let's say 6%. So if the voluntary retention route, through that the foreign portfolio investors are investing in the government securities, so this will be calculated towards this limit only. Okay, so with effect from April 1, 2026, all existing and the future investment under the voluntary retention route shall be subject to the investment limits, that is for the foreign portfolio investors under the general route. It will not have any separate limits. That is the basic idea. Okay, now the aggregate limit for the notional amount of credit default swap. Let's say how many of you have health insurance, or have you ever bought health insurance, or has your family ever bought health insurance? I hope that most of you have it. Why do you purchase insurance? So that whenever someone falls sick from your family, or there is any operation that is required, so you are buying the insurance. Let's say you are buying the health insurance, you are paying the regular premiums, right? You are paying the regular premiums on the monthly basis. Maybe you are paying the premium, or yearly basis you are paying the premium, but you are paying the regular premiums, or you are paying the premium. And what happens that you have the security that in case you are sick, in case someone needs operation in your family, then you have the security that the insurance company will bear the cost. Okay, or most of the cost will be borne by the insurance company. Okay, so this is the idea that you take the insurance for your safety. The credit default swap is nothing else. It is like an insurance. Let's say that I have given a loan. Let's say I have given a loan. I'm a lender, bank A. I have given a loan to XYZ company. Now I'm afraid it is a big company. It has taken a huge loan from me. It has taken a loan of 100 crores from me. Now I am afraid that what if this company defaults? What if this company closes down? So I want to divide my risk. So what I will do that in the market, I will purchase a credit default swap. Now by the term itself, you can understand that here the credit default is being swapped. I am buying this credit default swap by paying some premium amount on the regular basis, or maybe one time payment, or on the half yearly basis, yearly basis, I will pay this premium amount to the to some company, let's say ABC. So I have bought this credit default swap from the ABC company. I'm paying the premium amount to this ABC company for buying this credit default swap. I have paid some one-time amount. I am paying some premium amount also. Now, if the loan defaults, then the risk and the burden of the default will be taken by the ABC company. So this is the credit default swap. Basically, through the credit default swap, the bank A has got the insurance that if the default happens, then the responsibility to pay is of ABC. If the default does not happen, it is good. The free money, the free premium amounts have gone to the ABC. This is the insurance. In the case of insurance also, if you have not fallen sick, insurance company still gets the premium. But if you get sick, then whatever is the cost of the hospital, that has to be borne by the insurance company. So like the insurance company, this ABC company is also working. It is providing the credit default swap. It is getting the premium. It has to insure the loan. Okay, so this is the credit default swap. It is a financial instrument which serve as a form of insurance against the default of an underlying borrower or debt instrument. Let's say you are the investor. You have invested 10 crore rupees in this debt instrument through which company XYZ has borrowed. Now you are afraid that what if this company defaults, what if this company do not pay on time? So you have bought a credit default swap from a company ABC. Now you are paying the premium amount, you are paying some regular amount, some small amount you are paying, and if the borrower defaults, if the debt instrument defaults, then the ABC company has the responsibility to pay for your loss. That is the credit default swap. Got it? Any confusion? So aggregate limit of the credit default swaps that can be provided by the foreign portfolio investors, that can be sold by the foreign portfolio investors, shall be 5% of the total stock of corporate bonds. Okay, so it should not be more than that. This is the limit that has been determined, that if the foreign portfolio investors, they are providing the credit default swaps, it shall be like the total limit is 5% of the total value of corporate bonds that are present in the market, not more than that. Accordingly, an additional limit of 3,30,464 crore is set out for 2026-27. Now this is the idea. The amounts you don't have to remember, the percentages are important that you have to remember. So for the credit default swap, what is the limit for the FPIs? It is 5% for the 2026-27. That is the idea. Chalo, moving forward with the next direction for today, that is the master direction on incentives and penal provisions for the bank branches and currency chest. Let me do a RRR, that is revision. What is the limit for the government securities? I want rapid fire answers. Okay, so what is the limit for the government securities? Anyone? What is the limit for the foreign portfolio investors? What is the limit for the foreign portfolio investors for the government security investment? It is 6%. What is the limit for the foreign portfolio investors to invest in the state government securities? What is the limit? And for the corporate bonds? Okay, for the state government securities, it is 2%. For the corporate bonds, it is 15%. Okay, from the outstanding stock of securities. Now, coming to the government securities, from the incremental changes from the increased government securities, how much should go to the general investors? How much should go to the long-term investors? How much should go to the general investors? How much should go to the long-term investors? From the incremental change, the government of this government securities, the 6% is the limit again, but from the 6%, general investors should receive 50% of the investment, and long-term investors, long-term foreign portfolio investors should be able to do 50%. For the state government securities, what is the, from the incremental change in the state government securities, still 2% is the foreign portfolio investment limit, but for the general investors, under this limit, how much they can invest? For the long-term investors, under this limit, how much they can invest? Very good everyone. Good to see you all are answering correctly. For the general investors, it is 100%. They can invest till the limit 100%. For the long-term investors, from the incremental change, there is no increase. Okay, so that is the idea. Now, for the credit default swap, what is the percentage limit for the credit default swap for the foreign portfolio investors? What is the percentage limit? 50%. 50%? 5%. Okay, so for the credit default swap, the limit for the foreign portfolio investors is 5%. Okay, now coming to the next direction or the next news article. So master action on incentives and penal provisions for bank branches and currency chest in respect of currency operations. So first of all, see the idea, then you will get the better clarity. So first of all, RBI has formulated a scheme of incentives to encourage the banks for setting up requisite currency chest. So first, let's understand the definition so that you have the clarity about this topic. Okay, so here, what are the soiled, mutilated and imperfect notes? Soiled notes means a note which has become dirty due to normal wear and tear and includes a two-piece note pasted together wherein both the pieces presented belong to the same note and form the entire note with no essential feature missing. This is a soiled note. Okay, the note has got oil, or let's say the note is dirty, it is not clearly visible what is written, or it has been divided into two. Mutilated banknote is a banknote of which a portion is missing or which is composed of more than two pieces. Okay. Imperfect banknote means any banknote which is wholly or partially obliterated, that means it is not visible completely, shrunk, washed, altered, indecipherable, but does not include a mutilated banknote. Now, what is a clean note policy? Clean note policy basically states that the soiled notes, the mutilated notes have to be reduced from the economy, from the members of the public, and the members of the public should be provided with the clean note. So Reserve Bank of India has been continuously making efforts to make good quality banknotes available to the members of public. So that is a clean note policy, that instead of having the soiled or the mutilated notes, the people should be able to have the good quality banknotes. Okay. Now, what is this currency chest? To understand the currency chest, let's take an example that during the demonetization, what do you think that does RBI, like during the demonetization, the banks, they were collecting the old 500 rupee note and the old 1000 rupee note, and the RBI had to provide the new 2000 rupee note to the bank so that the bank can provide it to the public. Now there are multiple bank branches. So does RBI alone, or does RBI regional offices or the RBI head office was sending these new 2000 rupee notes to all the bank branches, and all the bank branches, were they individually sending their old 500 and old 1000 notes to the RBI, and RBI individually was sending the new 2000 rupee note to all the bank branches? Would it not be very cumbersome process? No, right? Actually, there is a middleman, that is the currency chest. The currency chests, they are available in different regions. See, what is the core function of the Reserve Bank of India? The core function of Reserve Bank of India is the monetary policy, the management of the foreign exchange, as well as currency management. Currency management is also a core function of the Reserve Bank of India. The RBI regulates the currency, the banknotes in the country. So RBI issues the banknotes in the economy, as well as RBI has the responsibility of managing the currency in the economy also. So during the demonetization, or normally also, if the bank requires the money, does the bank always, all the bank branches have to go to RBI to take the money? That okay, we have the 100 rupee notes, but we have the 100 rupee notes, but we require the 500 rupee notes to use it in the ATMs, to get it for the ATMs. So does all the bank branches have to go to RBI? No. There are the currency chests that are available. Now, what are the currency chests? To facilitate the distribution of banknotes and rupee coins, the Reserve Bank has authorized select scheduled banks to establish the currency chest. Like in your house, there is a tijori. There is a tijori. That your father is able to, your mother and father, they are able to access this tijori, and whenever your grandparents need the money, or let's say the children need the money from the family, they will get the money from the tijori through the father and mother. So that is the same idea, that the currency chest, it is available. Okay, and whenever the bank branches, the different bank branches in the area, they require the money, they go to the currency chest rather than going to the RBI in the regional offices or in the head office. Okay, so in different areas, in all the different areas, there are the currency chests that are available. So to facilitate the distribution of bank notes, to facilitate the distribution of rupee coins, the RBI has authorized select scheduled banks to establish the currency chest. These are storehouses. They are basically tijori. They are basically the storehouses where banknotes and rupee coins are stocked on behalf of the Reserve Bank of India for distribution of these banknotes, these coins to the bank branches in their area of operation. So in all the different areas of operation, there are different currency chests that are available. They are basically the scheduled banks that are authorized to work as the currency chest and to provide the different bank branches in their area with the banknotes. Let's say that my bank branch is A. I have multiple 100 rupee notes because the farmers are the depositors in my in my, or the laborers are the depositors in my bank branch. So they are depositing 100 rupee notes. Now I do not need so many of the 100 rupee notes, because for the ATMs I need the mix of 500 rupee notes also, but this is not available with me. So I will go to the nearby currency chest and I will exchange my 100 rupee notes with the 500 rupee notes, because my bank branch need 500 rupee notes or 10 rupee notes, let's say, or 100 or 50 rupee notes I require. So I will take whatever I need from the currency chest, exchange the money. Okay, or let's say I have too many deposits and the bank branch does not have high level of security, so I can deposit, like the bank branch, they can deposit their excess money with the currency chest also, because it is a storehouse, it can store the currency, it has that level of the security, CCTV and such. Okay, so this is the idea, that the currency chest, they provide multiple services to the nearby bank branches. Okay, so the multiple bank branches of the nearby area, they are linked. They are non-currency chest bank branches. They are linked with the currency chest. Okay, this is known as the linkage scheme, where the multiple non-chest bank branches, they are linked with the currency chest bank branch nearby. So rather than going to the RBI, you just have to go to your nearby currency chest that is available in your area. You need the coins, you need the currency note, you can get it from there. The bank branches, they can get it from there. This is the linkage scheme. The non-chest bank branches, they are linked with the currency chest bank branch. So this is the currency chest. The currency chest are expected to distribute banknotes, rupee coins to other bank branches in their area of operation, and this is the linkage scheme. Okay. Now, these are the storehouses where banknotes, rupee coins are stocked on behalf of the Reserve Bank of India. RBI wants to provide the new notes. RBI will provide the new notes to the currency chest, and the currency chest, the bank branches can go with their old 500 rupee note, old 1000 rupee notes, and deposit it in the currency chest and take the new notes. The currency chest will send these old notes to the RBI. So only the currency chest are connected with the RBI. The bank branches are connected with the currency chest. Okay, so this is the idea. Now, bank for distribution to bank branches. As on February 28, 2025, there were 2,691 currency chests, and currency chests are nothing else. They are the authorized select scheduled banks. Okay. So moving forward, I hope currency chest is clear to you now. So RBI has formulated a scheme of incentives. So RBI will be providing the incentives to encourage the banks for setting up requisite currency chest, because in all areas of operation there should be a currency chest so that the RBI can distribute the banknotes easily in that area or the coins easily in that area. Okay, so currency chest should be available in all areas of operation, especially in the far off areas also the currency chest should be available. And facilitating, the RBI has also formulated the scheme of incentives to facilitate distribution and exchange of notes and coins. Further, the RBI has also prescribed a scheme of penal interest or penalties in order to ensure accurate and timely reporting of currency chest transactions and provision of proper customer service to the members of public by the currency chest branches and the ATMs of the bank. So basically, there is the scheme of incentive. The scheme of incentive incentivizes for the establishment of the currency chest and facilitating the distribution of the clean notes. There is scheme of penalties. The penalties are for such kind of banks or such kind of bank branches, such kind of currency chest or the ATMs that are not following the rules and regulations. They are not providing proper customer service. So for them, there is scheme of penalties. Okay. So first, why the schemes have been launched, why the scheme of incentives, why the scheme of penalties. So in terms of preamble of the Reserve Bank of India Act, and as per the section 45 of the Reserve Bank of India Act and the Banking Regulation Act, the Reserve Bank of India issues guidelines, instructions for realizing the objective of clean note policy. Clean note policy is basically where the RBI wants to provide good quality banknotes to the member of public, right? So RBI issues guidelines, instructions for realizing the objective of clean note policy and enhancing the efficiency of currency management operations. So to enhance the efficiency of currency management, to complete its objective or to realize the objective of clean note policy, the RBI has released the scheme of incentives and the scheme of penalties. Okay, so this is the idea. Now, coming to the applicability, scheme of incentives and penalties mentioned in chapter 2. The chapter 2 is scheme of incentives, chapter 3 is scheme of penalties, okay? Will be applicable to all banks. All banks. There is no criteria, like there is no segregation that is given. All the banks, they will be under the scheme of incentives and penalties. Penal provisions for deficiency in operations of currency chest will be applicable to all banks having currency chest. So the penal provisions for deficiency in operation of currency chest, see, currency chest are directly under the Reserve Bank of India. They are authorized by the Reserve Bank of India to work as the currency chest. So the penal provisions for deficiency, if they are doing deficiency in operation, if they are not providing proper services to the bank branches, so they will be penalized by the RBI. Okay, so basically if the currency chest, they are having deficiency in their operations, they are not providing the proper services to the bank branches. Let's say the bank branches need 500 rupee note or they need 50 rupee note, the currency chest is not fulfilling the requirements and not sharing the requirements of the bank branches with the RBI. So in any deficiency in operation of currency chest, they will be penalized and such. This is the idea. Okay, next is these directions shall become effective on the day these are released on the website of the RBI. So they have already been released. Okay, now starting with the scheme of incentives, first we will discuss the scheme of incentives. The scheme of incentives incentivizes the bank branches including the currency chest based on the performance in rendering the customer service to the members of public. So scheme of incentives is for all the banks as well as for the bank branches that have the currency chest. This is to encourage all the banks or bank branches to provide better customer service as well as achieve the objective of clean note policy. So let's see the incentives now. So nature of service and the particulars of incentives. First of all, see, if a bank agrees to open, or if a bank is opening and maintaining currency chest in the northeastern region and at inaccessible or hilly areas or hilly places of Jammu and Kashmir and Ladakh Union Territories. So if there is the opening of and maintaining the currency chest in the northeastern region or at the inaccessible and hilly places of Jammu and Kashmir and Ladakh Union Territories, so in this case, the RBI will be incentivizing such bank that is opening its currency chest with a capital incentive of up to 100%. So capital expenditure is the one-time expenditure for the fixed assets in relation to the currency chest, because if currency chest has to be developed, that means security of that bank branch has to be increased, the CCTV has to be installed, the proper surveillance and security measures have to be adopted and such. So the one-time expenditure on the fixed assets, for that there will be 100% incentive, 100% reimbursement that will be done. So capital cost up to 100% of the capital expenditure is eligible for reimbursement subject to the ceiling of 50 lakh. So if a bank branch has done the expenditure of 52 lakhs for the establishment of the currency chest, so only up to 50 lakhs will be reimbursed. If let's say a bank branch has done 40 lakhs of the capital expenditure for the currency chest in the particular area, so the 100% will be provided, the 100% will be reimbursed, the 100% of the capital cost will be reimbursed up to the ceiling of 50 lakh. That is the ceiling, that is the highest. Okay, so this is the idea. The capital cost, the one time expenditure on the fixed asset for the currency chest, so up to 100% of the capital expenditure is eligible for reimbursement subject to the ceiling of 50 lakh rupees. Revenue cost, this is basically the cost of maintenance of currency chest, because if the CCTV has been installed once, the installation cost is once, but if there is any repair, if there is any maintenance that is required, so that is revenue cost, the maintenance cost as well as the operational cost of the currency chest. So the maintenance cost and the operational cost of the currency chest, for that 50% of the revenue expenditure is eligible for reimbursement for the first 5 years of currency chest operations. So let's say there is revenue expenditure of 10 lakh. Okay, 50% of that means 5 lakh will be reimbursed by the RBI. So you can understand, capital cost 100% reimbursement till the limit of 50 lakhs. Okay, revenue cost 50% of the reimbursement for the starting 5 years. So that is the idea. So revenue cost, 50% of revenue expenditure is eligible for reimbursement for the first 5 years of currency chest operations. The revised instructions would be applicable to the new applications for opening of currency chest in these areas received on or after April 25, 2025. So the already established currency chest in these areas will not get the reimbursements, but the new, like the currency chest that established on or after April 25, 2025, they will get the reimbursements. That is the idea. Capital cost and the revenue cost, I have explained you. Capital cost is the one-time expenditure incurred for acquiring the fixed asset for the currency chest. Revenue cost are the recurring expenses, the maintenance cost, operational cost. Okay. So this is the idea. Coming to the next nature of service, that is exchange of soiled notes, adjudication of mutilated notes over the counter at the bank branches or currency chest. So incentives will be provided to the bank branches or to the currency chest if they are receiving. See, currency chest, bank branches. So there are certain banks which are providing the currency chest operations, So does this bank branch or this bank branch cannot provide any other operations, or does this bank branch cannot take the deposits, cannot provide the loans? Is it so? No. This bank branch which is doing the currency chest operation, this branch is also providing the deposits, is also providing the loans. It is just having the additional authorization to work as the currency chest and to provide the currency chest functions and to provide the currency chest facilities to the linked bank branches. That's it. Okay, but this currency chest operation is done by the bank branch that has been authorized. Okay, so let's say the people, the members of public, they are exchanging their soiled notes, they are adjudicating their mutilated notes over the counter at the bank branches or the currency chest. So if the bank branches are receiving the soiled notes and mutilated notes, the exchange of soiled notes, ₹2 per packet. This is the incentive that will be provided by the RBI. That exchange of soiled notes, ₹2 per packet. In one packet, there are 100 notes. Okay, for exchange of soil notes in the denomination of ₹50 and below. So basically, through this table, you might be able to understand better that let's say the bank has received 5,500 soil notes, okay, of 10 rupee denomination, and the bank has received, let's say 20 rupee soil notes of 7,500 rupee denomination. So in one packet, how many notes are there? In one packet, there are 100 notes. So in total, there are 55 packets. After taking the deductions, after taking into account the total discrepancy, let's say 53 packets are there. 53 packets means per packet 2 rupee of the incentive. So that means 106 rupee of the incentive will be provided to the bank. Okay, and here we are only talking like in small numbers, but if you see in the big numbers, the incentive can be higher. So this is the idea, that exchange of soiled notes per packet 2 rupee is the incentive for the banks for the exchange of soiled notes that are 50 rupee and below. Let's say the notes are above 50 rupees, so for that there is no incentive. For the bank. So this is the idea, that if the bank is exchanging the soiled notes, basically the bank is receiving the soiled notes and is sending the soiled notes to the RBI. So the bank will get the incentive of 2 rupee per packet for exchange of soiled notes in the denomination of ₹50 and below. If the adjudication of mutilated notes is happening, that means the customer, it came to the bank to give the mutilated note. Now the bank has taken this mutilated note, gave a new note to the customer. Now this mutilated note was sent to the currency chest, and the currency chest will send this mutilated note to the RBI. RBI will give the incentive through the currency chest. Currency chest will distribute the incentive to the bank branch from where the mutilated note came. So this is the basic idea. In the soiled note category also, the bank is receiving the soiled note from the customers, and the bank branch is giving the clean notes to the customers. These soiled notes are sent to the currency chest, and from the currency chest, these soiled notes, they go to the RBI. The RBI provides the incentive to the currency chest. Currency chest distribute the incentive to the bank branches. This is the idea. Okay, so I hope this is clear, that for the exchange of soiled notes, there is incentive of 2 rupees per packet. In one packet, there are 100 notes. Okay, so rupees 2 per packet for exchange of soiled notes in the denomination of rupee 50 and below. For the adjudication of mutilated notes, notes 2 rupee per piece. This is the incentive. Now distribution of coins, see, this is a problem that in the economy there is not as much coins that are available that is required by the people. So it is usually felt that the coins are not present in the sufficient quantity in the economy. That's why the RBI is saying that for the distribution of coins, there will be incentive that will be provided to the bank branches, to the banks. So basically, distribution of coins, what is one bag of coin? What is one bag of coin? So for incentive calculation, 5,000 pieces of 50 paise coins, 2,500 pieces of 1 rupee, 2 rupee, 5 rupee coins, and 2,000 pieces of 10 rupee or 20 rupee coins would be deemed to constitute one bag. Okay, and 65 rupees per bag. This is the incentive for the distribution of coins, 65 rupees per bag. In an additional incentive of 10 rupees will be provided if the bag of coins is provided in the rural or semi-urban areas on the submission of a concurrent auditor certificate to this effect. So basically 65 rupees per bag for the distribution of coins. 65 rupees is the incentive per bag for the distribution of coins in the urban areas, and 65 rupees plus 10 rupees, that is 75 rupees. This is the incentive per bag. This is the incentive per bag for distributing the coins in the rural or semi-urban areas. This is the idea. Okay. Next is cash deposit by non-chest bank branches. Now let's say the currency chest is providing the services to the non-currency chest bank branches. So currency chest bank branches, it is providing the services to various different non-currency chest bank branches in its area. Is it doing for free? The currency chest will provide these services for free. It is taking the 100 rupee notes, providing the 500 rupee notes. It is taking the deposits or providing the security and such. So currency chest will it do for free? No, there is a service charge that is taken. Okay, so cash deposit by non-chest branches under linkage scheme with currency chest. So basically for the cash deposit, it will take the service charge. Okay, for the other facilities, it will provide for no service charge or such. But for the cash deposit, let's say non-chest branches, non-currency chest branches, they want to deposit their money with the currency chest, because these non-chest currency chest branches, they do not have much security, but they have got huge deposits, so they can deposit their money with the currency chest to remain so that the money remains safe. So cash deposit by non-chest branches under the linkage scheme with the currency chest, service charge to be levied by the currency chest on the non-chest branches. Large modern currency chest, if we are talking about the large modern currency chest, rupees 11 per 100 pieces of the banknotes. This is the service charge. Other currency chest, rupees 8 per 100 pieces of the banknotes. This is the service charge. So cash deposit by non-chest branches under linkage scheme with the currency chest will garner the service charge of rupees 11 per 100 pieces from the large modern currency chest, and other currency chest can take the service charge of rupees 8 per 100 pieces. Large currency chest is basically the currency chest that have the large modern currency chest. They are the currency chests that have the modern facilities and the chest balance limit of at least 10 billion rupees. So that is the idea. Okay, so this is the service charge that is levied by the currency chest on the non-chest branches for taking the cash deposit. This is the idea. Any confusion? Now shall we do a rapid fire before going forward? Let's do a rapid fire round. For the currency chest that is being operated and maintained and established in the northeast region and in the hilly inaccessible region of Jammu and Kashmir. So what is the capital cost reimbursement that will be done? What is the capital cost reimbursement that will be done? Tell me first. Capital cost reimbursement will be 100%, subject to the ceiling of 50 lakh, while the revenue cost reimbursement will be 50% for the period of how many years? 5 years. Okay, next, so this is clear. Next point is the coins. For the distribution of coins, the incentive is how much? In the urban areas, rupees 65 per bag of coins. Okay, and in the rural areas, in the semi-urban areas, what is the incentive for the distribution of coins? Rupees 65 plus rupees 10, that is rupees 75 is the incentive, 10 rupees additional. Okay. Now, if the soiled notes, they are being deposited, or if the mutilated notes are being provided in the bank branches or in the currency chest, okay, and the bank branches are providing these soiled notes to the currency chest, which is further sending these soiled notes, mutilated notes to the RBI. So what is the incentive for the soiled notes? What is the incentive RBI will provide for collecting the soiled notes? Rupees 2 per packet. But soil notes, the incentive will be provided only if the soil notes are of 50 rupee denomination or lower. Okay. For higher denomination soil notes, there is no incentive basically. Now, for the mutilated notes, what is the incentive? Anyone? What is the incentive for the mutilated notes? Rupees 2 per piece. Not packet. Mutilated notes, rupees 2 per piece, and there is no such limit of denomination. Okay, so this is what we have discussed. The last point was that the cash deposit done by the non-chest branches to the currency chest, what is the service charge by the large modern currency chest? So it is 11 rupee per 100 pieces, and by the other currency chest, the service charge is rupees 8 per 100 pieces. This is the idea. Chalo, so this is what we have discussed. Okay, the exchange of soiled notes. For the exchange of soiled notes, see, basically the bank branches is taking the soiled notes, is taking the mutilated notes from the customers and returns the good notes, the clean notes to the customers. The bank branches send the soiled notes, mutilated notes to the currency chest, which further sends it to the RBI, and RBI provides the incentive through the currency chest, and further currency chest sends the incentive to the bank branches. This is the idea. This, let's understand this more. So the incentives. Now, operational instruction on payment of performance in based incentive. So what are the operational instructions? We have discussed about the performance based incentive. If the banks are collecting the soiled notes, if the banks are collecting the mutilated notes, if the banks are distributing the coins, so there are performance based incentive. Now, operational instructions on payment of performance based incentive. So the incentives in respect of bank notes shall be paid on the basis of the soiled notes that are actually received in the issue office of the RBI. So let's say the customer gave the bank branch the soiled notes and the mutilated notes. Now the bank branch is giving this to the currency chest is giving this to RBI. Now some of the notes were found missing, that the notes were not present at all in the packet that was sent to the RBI. Or let's say some notes were counterfeit notes, fake notes. The bank branch accepted fake notes. So against that also RBI will not provide any kind of incentive. So the actual soiled notes, see here you can see. So out of the total notes, 110 notes were found like to be in shortage or mutilated or counterfeit in pieces. And that's why the number of notes were counted less, that actually RBI received less. And so rather than 55 packets, RBI gave incentive only on the 53 packets. So for the soiled notes, 2 rupee per packet. So this is the idea, that this incentive will be given only on the notes that is actually received by the issue office of the RBI, not what is claimed by the bank branches. Adjudicated notes, that is the mutilated notes, if they are received along with the soiled note or sent separately by the registered or insured post in a sealed cover to the RBI, so the incentive will be given on those mutilated notes also, rupee 2 per piece. Okay. Next is the incentive for distribution of coins shall be paid on the basis of net withdrawal from the currency chest. The idea is that the incentive for distributing the coins, if the distribution of coins is happening, let's say the bank took a bank branch has taken 65 coins from the currency chest, but the bank branch has also deposited 55 coins with the currency chest. So can we say that the bank branch is increasing the distribution of coins by 65 in the economy? So 65 coins have been withdrawn from the currency chest to provide to the public, while 55 coins have been deposited in the currency chest. So in total, the net withdrawal is only of 10 coins. So the incentive for distribution of coins, the incentive that will be provided, 65 rupees per packet per bag of coins, sorry, 65 rupees per bag of coins, and rupees 75 per bag of coins in the rural or semi-urban areas. So this incentive will be provided on the net withdrawal from the currency chest. If the banks are withdrawing, let's say 10,000 coins, 10,000 number of coins have been withdrawn from the currency chest, but the bank branches have deposited back 7,000 coins. So in total, only 3,000 coins the bank branches are distributed in the economy. So the distribution is not increasing by 10,000 that has been withdrawn, because the 7,000 was deposited back to the currency chest. So this is the idea, that the incentive for distribution of coins shall be paid on the basis of net withdrawal from the currency chest. Okay, so this is the idea. Next is the currency chest holding banks shall raise invoice to the RBI for claiming the incentives. Like I have told you that the bank branches are not directly connected with the RBI in terms of the currency management. The bank branches will send the soiled notes, the mutilated notes to the currency chest. Currency chest will send it to the RBI, and the currency chest will also raise an invoice to get the incentive. So currency chest will receive the incentive. Now currency chest branch shall pass on the incentive. Currency chest branch has raised the invoice, has got the incentive for all the soiled notes, for all the mutilated notes, and the currency chest has the responsibility to transfer the incentives to the bank branches. So currency chest branch shall pass on the incentive to the linked branches for the soiled notes deposited or coins distributed or mutilated notes that have been adjudicated by them on pro rata basis on the same rate basis that the RBI is providing the incentive of. Okay, the distribution of coins shall be verified by the RBI regional offices that the coins are actually distributed amongst the public or not, through the inspection of currency chest, incognito visit to branches, etc. Okay, so this is the basic idea. Any confusion? So basically, the bank branches, they are collecting the soiled notes, they are collecting the mutilated notes, they send it to the currency chest send it to the RBI and raise the invoice for the incentive. To get the incentive, RBI will provide the incentive to currency chest, and currency chest will share the incentive to the linked branches on the basis of how much soiled notes, how much of the mutilated notes have been received from a particular bank branch, how many bags of coins has been distributed by the branch bank branch. So according to that, the incentives will be sent by the currency chest. Okay, so this is the idea. We have discussed the preliminary, we have discussed the multiple definitions for the soil notes, currency chest, clean note policy. We have discussed the applicability, that is to all the banks. We have discussed the short title. See, the short title is basically this: the master action on incentives and penal provisions for bank branches and currency chest in respect of currency operation. This is the short title of the master direction. Okay, so first chapter is done. The second chapter, scheme of incentives, this is also what we have done. Now the third chapter, that is penalties, the scheme of penalties, that we will do in the next session, because it has multiple data points and I do not want you to get confused with the different data points. Focus on the session that I have taken today, where we have discussed the two chapters and the limits for the FPIs. In the next session, we will discuss the scheme of penalties and the penal provisions. These two chapters are important. The fifth chapter is not so important. Okay, so two chapters have been done. The two chapters will be done in the next session. So this is it. Now the Utkarsh 2029 has also been Utkarsh 2029 has also been released by the Reserve Bank of India yesterday only. I will take a session. So in the next session, we will complete this master action, and in the coming session, that is on like Tuesday, I will take the master action. On Thursday, I will take the Utkarsh 2029. Okay, this document. This is very important document. Okay, any confusion? How many coins are there in one bag? So I have shown you that there are 5,000 pieces of 50 paise coins, 2,500 pieces of 1, 2 or 5 rupee coins, 2,000 pieces of 10 or 20 rupee coins would be deemed to constitute one bag. Any confusion, anyone? Now. Okay. Thank you then. Thank you for attending the session. Next, in the next session, we will also talk about the penalties. See, too much data in one session not required, or you cannot remember all of that. So right now focus on whatever has been provided, and the next two chapters we will discuss, like all the chapters, the next chapters we will discuss in the next session, but these two chapters are more important. The last one is not so important. Okay, so we will discuss it on Tuesday. We will finish it on Thursday. I will take this very important document of Utkarsh 2029. Now this is the first question. I hope you will be easily able to answer this question. Consider the following statements regarding limits for investment in debt and sale of credit default swaps by FPIs. Which of the above statement is or are correct, that you have to inform. I hope you will be easily able to answer this question. Now coming to the second question, RBI has issued master action on the incentives for currency distribution. We have discussed the scheme for incentives. So according to that, which of the below statements is or are correct in regards to the master action? So try to answer these questions. Okay. So this is the second question. Try to answer this. So this is it for today. Thank you everyone for joining. Okay, I have taken paid course. Do I have to revise this PPT as well? No. You will get the RBI News tab document. Okay, for 1st to 15th. Then you can get the article. But if you read the PPT, then this article will become very easy. Okay, so in the PPTs in the session, we are discussing the most important points. So if you already read the PPT, if you already have gone through the session, then the document will become very, very easy for you. So you can go through the document directly, which will be provided by 19th, I guess. This is upon you. If you have understood, then it is fine. Okay. Chalo. Thank you everyone. Thank you for joining. See you in the next session.